Let me tell you about the most dangerous phase in a retail trader's career. It's a phase I call the false dawn. It goes like this. You have a great Monday. You catch a beautiful setup and you make 2%. On Tuesday, the market lines up perfectly again. You execute and you make another 2%. Wednesday comes around, you are in the zone. You catch a quick scalp, another 1.5%. You look at your dashboard, you are up 5.5% for the week. You lean back in your chair, look at the ceiling, and you say the most dangerous words a trader can ever speak. I finally figured it out. I am finally a consistent trader. You mentally calculate how much you are going to make by the end of the year. You start looking at Rolexes. You think you have unlocked the matrix. Then Thursday arrives. You take your normal setup, it loses. You're a little annoyed, but hey, you're a consistent trader now, right? So you take another trade to get it back. It loses again. Now your week is down to plus 3%. The panic sets in. The illusion shatters. By Friday afternoon, not only is your 5.5% profit completely gone, but you are actually down 2% for the week. You sit there, staring at the red numbers, and you think, why can't I just be consistent? Today, we are going to destroy the biggest lie the trading industry has ever sold you. Inspired by the teachings of Mark Douglas, we are going to redefine what consistency actually means. We are going to break down why trying to make a consistent daily income is mathematically impossible, and how shifting your definition of this one single word will permanently remove the stress from your trading. Lock the doors, put your phone away. It's time to fix your brain. Chapter 1. The Lie of the Steady Paycheck. The reason you struggle with consistency is because you're using the wrong dictionary. You're using the employee dictionary. In the 9-to-5 world, consistency is measured by the result. If you work 40 hours a week at a job that pays $25 an hour, you will consistently receive a $1,000 paycheck every single Friday. The result is guaranteed. The result is consistent. So when you transition to trading, your brain expects the same dynamic. You think, if I put in 4 hours of chart time every day, the market owes me $200 a day. You view consistency as an upward straight-line equity curve. You think being a consistent trader means making money every day, or at least every week. Listen to me very carefully. The market is not your employer. The market does not pay an hourly wage. In trading, consistency of result is a myth. If you look at the track record of a legitimate multi-million-dollar hedge fund, their equity curve does not look like a perfectly straight line going to the moon. It looks like a jagged mountain range. They have losing days. They have losing weeks. Sometimes they have entire losing months. If the smartest financial minds on Wall Street with billion-dollar algorithms cannot produce a consistent daily profit, what makes you think you can do it on your laptop in your bedroom? You have to completely abandon the idea that consistency means winning all the time. If you measure your consistency by how much money you made today, you will forever be trapped in an emotional roller coaster. Chapter 2. The Action versus the Outcome. If consistency doesn't mean making money every day, what does it mean? Mark Douglas teaches us a very simple, incredibly profound truth. Consistency is not found in the outcome. Consistency is found in the execution. Let me say that again so it burns into your brain. You cannot control the outcome of the trade. You can only control your execution of the trade. Therefore, a consistent trader is simply someone who consistently executes their edge exactly the same way over and over again, regardless of what the previous trade did. Think about a professional basketball player shooting a free throw. He steps up to the line, he bounces the ball 3 times. He spins it in his hands. He bends his knees at the exact same angle. He releases the ball with the exact same flick of his wrist. Does the ball go in every single time? No. Sometimes it hits the rim, sometimes it bounces out. But his process is 100% consistent. Because his physical mechanics are consistent, the mathematical probability dictates that over the course of an 82-game season, he's going to make 85% of his shots. Right now, your trading mechanics are a disaster. You risk 1% on Monday. On Tuesday, you get bored, so you risk 3%. On Wednesday, you take a trade on the 5-minute chart instead of your usual 15-minute chart because you felt like it. On Thursday, you move your stop loss because you don't want to lose. You are demanding a consistent payout from the market, but you are giving the market wildly inconsistent actions. The market is a mirror. If you throw chaos at it, it will reflect chaos back to your bank account. Chapter 3. The Sample Size. Escaping the Micro View. To achieve true execution consistency, you have to change how you view time. Most retail traders live and die by the 24-hour clock. You wake up, you trade, and at 5 p.m., you judge yourself. Did I make money today? Yes, I'm a good trader. Did I lose money today? Yes, I'm a terrible trader. This is the micro view. And in the micro view, the market is 100% random. If I have a coin that is weighted to land on heads 60% of the time and I flip it exactly one time, can you guarantee it will land on heads? No, it could easily land on tails. If I flip it 5 times, it could land on tails all 5 times. In a small sample size, anything can happen. But if I flip that coin 1,000 times, the micro randomness disappears. The macro probability takes over. It is a mathematical certainty that after 1,000 flips, roughly 600 of them will be heads. You cannot be a consistent trader if you judge your system after every single trade, or every single day. You must adopt the macro view. You stop judging your success by the day, and you start judging it by blocks of 20 trades. When you sit down at the desk, your mindset should be, I am simply executing trade number 4 out of my next 20 trade sample size. The result of this specific trade does not matter. The only thing that matters is that trade number 4 looks exactly like trade number 1. When you expand your time horizon, the pain of a losing day completely evaporates. A losing day is just a sequence of tails. It is statistically irrelevant. Chapter 4. Emotional Flatlining. The State of Mind. We have covered consistent mechanics and consistent sample sizes, but there is a third pillar, and this is the one that destroys 90% of people. You cannot have consistent physical execution if you have an inconsistent state of mind. Think about it. If you are extremely angry because you just got into an argument with your spouse, are you going to execute your trading plan flawlessly? No, you are going to revenge trade. You are going to force setups. If you are extremely euphoric because you just had the best winning week of your life, are you going to manage risk properly? No, you are going to feel invincible and over-leverage your next position. Mark Douglas calls this the state of mind. To be a consistently profitable trader, you must cultivate a consistent, neutral emotional baseline. You have to train yourself to be completely indifferent to the flashing lights on your screen. When you win a trade, you do not celebrate. You do not go buy a bottle of champagne. You nod your head, log it in your journal, and wait for the next setup. When you lose a trade, you do not scream. You do not punch your desk. You nod your head, log it in your journal, and wait for the next setup. You must become emotionally flatlined. If your happiness is tied to your MetaTrader balance, the market holds you hostage. The market controls your mood, your relationships, and your self-worth. You must detach. Your self-worth does not come from the outcome of the trade. Your self-worth comes from your ability to follow your own rules. Chapter 5. The Boring Protocol. I'm going to give you the blueprint for exactly what consistency looks like in the real world. I call it the Boring Protocol because let me tell you the ultimate secret of this industry. Good trading is incredibly, painfully boring. If your trading feels exciting, you are gambling. Here is your consistency checklist. Before you take your next trade, you must answer yes to all 4 of these questions. Is this the exact same setup I traded yesterday? No new indicators, no new time frames, the exact same edge. Is this the exact same risk percentage I used yesterday? No scaling up because you feel lucky, no scaling down because you're scared. Am I willing to accept the complete loss of this risk without a single emotional reaction? If the answer is no, your lot size is too big. Am I willing to let this trade play out to its logical target without interfering? No micromanaging the position because a 1-minute candle turned red. If you can do this, if you can execute this boring, repetitive, mechanical checklist day after day, week after week, you will look up in 6 months and realize you are profitable.
Not because you predicted the market perfectly every day, but because you finally provided the market with consistent actions and the probabilities finally paid you out. Conclusion. Consistency is not a dollar amount. It is not a straight line on a graph. Consistency is a behavioral trait. It is the disciplined refusal to let the random outcome of the market dictate your physical actions. Stop trying to force the market to pay you an hourly wage. Become the casino. Standardize your execution. Expand your sample size and flatline your emotions. That's the real meaning of consistency. If this masterclass finally rewired how you look at the charts, hit that subscribe button. Join our community. We don't chase daily profits here. We chase flawless execution. Leave a comment below right now. What is one action you do in your trading that is completely inconsistent? Is it your lot sizes? Your stop losses? Let's expose it in the comments. I'll see you in the next one. Stay disciplined.